Hey guys, I came across something really interesting this week, and I think you'll find it interesting as well. So I decided to create a video just on this. So think about this as a bonus video, free of charge as always. So I found a company that's trading at a 27% discount to Morningstar's valuation. It's got a high Simply Safe dividend rating. It's got a market-beating yield. And best of all, it's got a 68% 5-year dividend CAGR. But I've decided not to buy it. If you want to know why, stay tuned. Hey guys, Kevin Burgess back again with another video. This week I want to talk about a particular company that I came across. And the little background story is we had gone on a trip a couple of weeks ago, went out one morning to start the vehicle and just clicked. All it did was click. It did not turn over. So knew at that point I needed a battery. So was able to get the car, jumped off, and went to a company called Advance Auto Parts. Now, the battery was pretty expensive, but the service was incredible. So I thought, hey, I'm gonna look into Advance Auto Parts and see if it belongs in my portfolio somewhere. So let's take a look at what I found. So Advance Auto Parts provides automotive replacement parts, accessories, batteries, like in my case, and maintenance items for domestic and imported cars, vans, SUVs, light and heavy duty trucks. The company offers battery accessories, belts, hoses, brakes, brake pads, and you get the story. They just have a litany of parts that they supply. They have nearly 4,700 stores in the U.S., Puerto Rico, and the U.S. Virgin Islands and Canada. And they also own about 1,300 CarQuest branded stores overseas. They were founded in 1929 and are based in Raleigh, North Carolina. So let's take a look at Simply Safe Dividends. You can see that their dividend safety rating in Simply Safe Dividends is 89 out of 99. That's pretty high. They got a very safe dividend. You can see that their yield is roughly 3.5%. Let's take a look at their dividend growth here. You can see that of the last 5 years, their dividends have grown on an average of 68%. However, they've only grown their dividend for the last 2 years, but they have paid a dividend for the last 15. Now, Simply Safe Dividends says, hey, this company may be undervalued. They have a dividend yield of 3.49%, which is significantly higher than the 0.54% historical 5-year average. And the PE ratio, instead of being 18 like the 5-year average, it's now down around 12. Let's look at a few metrics here. Their earnings payout ratio is reasonable. I mean, they've grown their dividend a lot, so to still have only a 43% forward-looking earnings payout ratio is actually pretty good. Then this caught my eye, 113% free cash flow payout ratio. So we're going to dig into that a little bit, but let's keep going here. You can see that their earnings per share, while they've had some dips, have trended in the longer term toward up and to the right. And again, free cash flow per share falling off significantly. Let's look at shares outstanding. They've gone from 74 million in 2012 to 62 million currently. One of the things I love to look at is return on invested capital. You can see back in the 2012-13 time frame, they had some pretty decent return on capital. However, over the past 5 or 6 years, that has dropped into the low teens, which is still not horrible, but it's not the greatest either. Then the other thing I want to look at is debt, and you can see that their debt has grown a bit. They are now at 0.58, so 58% of their capital structure is debt. And when I look at the interest coverage ratio, however, they do have the capability of covering that debt, so that's not too concerning. One other thing to point out is that Fast Graphs would tell us that this is a possibly reasonable time to enter a position in Advance Auto Parts. I wanted to pass this on to you because one of the things that matters most for us as dividend growth investors is our due diligence process. And we need to be diligent about our due diligence process. So let's take a look at some of the things I did for Advance Auto Parts, and I'm going to compare them to another company that I actually invest in, so you can see the difference between how the two companies address this particular issue. So what you see in front of you here is their earnings release for the second quarter. And I just highlighted a few things that they focused on. They focused on their growth in net sales and operating income. Their income margin rate was the highest in the last 7 years. Their earnings per share increased 10% and 72% compared to 2019. They returned $291 million to shareholders, which was a combination of repurchases and the dividend. So, I read that and I go, wow, this is really pretty cool. But then I come down here to net cash, and I see that net cash provided by operating activities was $308 million. Free cash flow, which is the net cash provided by operating activities minus capital expenditures, was only $97 million. But they don't give you here the comparison to what it was last year. You have to read a little bit further for that. So down here near the bottom, you'll see a bit more discussion on the free cash flow. The free cash flow through the second quarter of 2022 was $97.3 million, compared to $646.6 million in the same period the prior year. Now, it's important to point out that the free cash flow that they're talking about here is not a quarterly cash flow, but it is through the second quarter of 2022. So this $97.3 million is for the first 6 months, not for the 3-month period. Now let's move down a little bit here, and they've updated their guidance, and their guidance has dropped in free cash flow from what they said was a minimum of $775. They've dropped it by about $75 million, which is not completely alarming. After we go through some numbers, I don't understand how they're going to get there. So let's take a little pit stop here at the statement of cash flows. Some of the things that are driving the net cash from operating activities to be lower in this year versus last year is net income is down. And then these three things are what they call working capital. It's receivables, inventories, net offset by payables. So those two things, the net income is down about, $80 million, and the working capital is down significantly. You can see that receivables are higher by $149 million. Inventories are higher by $176 million. They didn't pay their bills as quickly, so that's given them some free cash flow of $168 million. So there's a significant amount of cash tied up in inventories, receivables, and lower net income. So the thing, though, for me that's a bit alarming is that they have begun to borrow money to pay for their dividends and their stock repurchases. So they've borrowed some money. You can see that here. The net of these credit facilities is about $100 million. The net of the unsecured notes is about $150 million, let's say. So $250 million of debt has been incurred to help cover the cost of the dividend, the repurchases of stock, and the capital expenditures. And you'll look down here at the bottom, I did not highlight this, but the cash and cash equivalents at the end of the period is $240,551,000 versus $809 million. So their cash balance has dropped significantly as well. So one other thing I want to point out is the reconciliation of non-GAAP financial measures. You'll see LIFO impacts. They value their inventory on their balance sheet on a LIFO basis, which means that any inventory that comes in most recently gets expensed first. So typically in a period of rising prices, your balance sheet would be lower because you have older prices in there and your income statement takes a hit. So what they're doing here is they're adjusting their net income by these LIFO impacts. So if you stayed with me this far through this technical stuff, I appreciate it. I promise I'm coming to a point here. But the reason that we're seeing the cash flow impact and not the earnings impact is because these LIFO impacts are showing up as a benefit to the balance sheet, but as a hurt to the P&L. But they're excluding this hurt from the P&L in their non-GAAP numbers. So the payout ratio that we saw earlier that looked pretty good at 43% has this LIFO impact excluded from it. The point is, Advanced Auto Parts has some really good numbers, but their cash flow has taken a hit. And the thing that I don't see in their quarterly report or even in any of the analyst comments in their second quarter earnings call is, what are you going to do to get this cash flow back in line? You've got $97 million so far in the first 6 months of the year. You say you're going to have $700 million by the end of the year. That's a $603 million change. How are you going to get $603 million? So let's take a look at another company and I'll show you what I was expecting to see. Now, this is the second quarter presentation by Stanley Black & Decker. You'll see that here on this slide. And for full disclosure, I own some Stanley Black & Decker shares, but I see a slide here that says, hey, we are acting with urgency to reduce inventory. They're talking about their production curtailments, focused commercial actions, safety stock optimization. They've laid out here what their strategy is to get their working capital back in line with what it needs to be. I don't see that at all in the Advanced Auto Parts materials. So the point is, for Advanced Auto Parts, I don't see the urgency around getting their working capital back in line, which they're going to need to do in order to reach the $700 million. So while the numbers look really good overall, this free cash flow causes me a bit of caution. So I'm going to put them on my watch list, but I am not going to invest in them at the moment, because I'm a bit concerned that they're not focusing on their cash flow and they're going to incur more debt and disappoint shareholders in the coming quarters. So I appreciate you staying with me through all of that due diligence technical discussion. And if you have any questions about any of it, leave me a comment below. Also, I'd like to know whether you are an investor in Advanced Auto Parts and what your take on this situation is. I'd be interested to hear your thoughts on that. Also, if you're still here on the video and you found this to be valuable, if you wouldn't mind clicking that like button, and if you're not a subscriber, go ahead and subscribe. I'd love to have you along for the journey. So with that, I'll see you on the next video.